At this point in time, over 28 private equity firms have made over 200 roofing company acquisitions, and hundreds of investors are currently eyeing the roofing industry. So what does an example deal look like? Let's break down a simple example. Private equity deals, they can be game changers, but there's risks that you need to watch out for. So a lot of roofing company owners, they already get private equity because they've been through the process. But some, they're still trying to figure it out. So today, we're gonna break down the basics. We're gonna talk about why private equity is targeting roofing companies. We're also gonna talk about what private equity firms look for, how deals are structured, and the private equity process. We'll also talk about how you can make your business more valuable and more attractive to investors. Before we begin, let me introduce myself. I'm John Palmatier. I've led marketing for startups, billion-dollar organizations, and a top marketing agency. Now, as the founder and CEO of TrustFactors, I help roofing companies break free from the broken marketing agency model so they can grow faster. By the end of this video, you'll have a clear understanding of private equity and how it might apply to your business. We're going to cover a lot of ground, so check out the chapter headings below if you want to skip around a little bit. Remember, this video is for informational purposes only. Please consult legal, financial, and tax professionals before making any decisions. Let's get started. So what is private equity? Private equity is when groups of investors team up to buy businesses, make them better, and then sell them for a profit. It's kind of like flipping houses, but instead of remodeling kitchens and bathrooms, they're fixing up businesses to make them run smoother and grow faster. Here's how it works in 4 simple steps. First of all, they pool money. Investors like retirement funds, wealthy individuals, or companies put their money together. Then they buy businesses. They look for companies like roofing companies that have a lot of potential to grow and improve. They use different strategies to increase value. Some private equity firms focus on operational improvements, helping businesses upgrade equipment, improve marketing, or streamline processes. Others specialize in roll-ups, acquiring multiple businesses in the same industry, like roofing companies, and combining them to create a larger, more valuable company. Some may focus on restructuring, optimizing costs, or preparing a business for strategic mergers. They sell for a profit. After a few years, they sell the business for way more than they paid. Private equity, it's not a one-size-fits-all approach. And every firm has its own playbook. Understanding their strategy helps you know if their vision aligns with the goals that you have for your business. So why roofing? Well, roofing is one of the hottest industries for private equity, and here's why. Profitability. Roofing companies can achieve high profit margins when they run efficiently. Steady demand. People always need roofs, storm damage, aging homes, new construction. It's not recession proof, but it's recession resistant. Fragmentation. There's over 99,000 roofing contractors in the US, and most of them are part of small local businesses, so there's a lot of room for consolidation. Private equity loves industries like this because they can buy smaller companies, merge them, and create bigger, more efficient businesses. Market growth. The US roofing industry is roughly $55 billion and growing at 3 to 4% per year. They've seen this movie before. They've already had a lot of success in commercial landscaping and HVAC, and the roofing industry is the next logical step. At this point in time, over 28 private equity firms have made over 200 roofing company acquisitions, and hundreds of investors are currently eyeing the roofing industry. So what do private equity firms look for? Private equity firms are looking for businesses with strong growth potential, profitability, and operational efficiency. Here's what matters most. Revenue growth. Steady, consistent revenue growth is the biggest factor. Private equity firms love businesses that show scalability. EBITDA. This measures profitability. Private equity firms all have their own sweet spots, but generally, roofing companies start getting private equity interest when they hit about $1 million in EBITDA. Cultural alignment. Private equity firms want leadership teams and company cultures that align with their goals. They'll often want you to stay on for at least a year, so a strong fit, it's critical. Reputation. A strong reputation, it's table stakes now. Positive reviews, customer testimonials, and brand trust make your business more attractive to investors. Operational strength. Streamlined processes, built-out CRMs, and documented workflows help show that your business is scalable. Financials in order. Having clean, accurate financials is critical. As a side note, private equity firms generally prefer accrual accounting because it gives a clear picture of your profitability by matching revenue with expenses. For example, if you complete a roofing job in December but don't get paid until January, accrual accounting ensures that the revenue is recorded in December, reflecting your true performance. Without clean financials, deals can and often do fall apart during due diligence. So what is the private equity process? When a private equity firm approaches you, the process can feel overwhelming. Here's a detailed breakdown to help you navigate it. Initial contact. A private equity firm reaches out to express interest in your business. They'll ask for high-level financials to see if your business fits their criteria. Non-disclosure agreement. Before sharing detailed information, you'll sign an NDA to protect sensitive data such as your financials and customer lists. This step ensures confidentiality and it builds trust. Due diligence. This is a deep dive into your business's financials, operations, contracts, and so much more. Expect to provide tax returns and detailed financial statements, customer contracts and supplier agreements, information on your processes, your team, and your systems. This step is critical as it determines whether the deal moves forward or not. Letter of intent. After the initial review, or sometimes earlier to secure exclusivity, the private equity firm issues an LOI. This non-binding document outlines the purchase price, whether the deal is for full or partial ownership, payment terms such as upfront cash or earnouts. Note that some LOIs include an exclusivity period, which is typically 30 to 60 days, during which you can't entertain other offers. Be sure to negotiate these terms with your attorney. Valuation and offer. The private equity firm finalizes your company's valuation based on EBITDA multiples and other metrics. Offers may include upfront payments, which is cash paid at closing, earnouts, which are payments tied to future performance, contingencies, conditions that must be met before the deal is finalized, negotiation and closing. After finalizing terms, you and your legal and financial advisors review the agreements, ensuring that everything aligns with your goals. This stage also includes final signatures. So what does an example deal look like? Let's break down a simple example. Imagine your roofing company brings in $5 million in revenue annually with $1 million in EBITDA. A private equity firm offers you a 5x multiple, meaning your business is worth $5 million. Here's how the deal might look. You could get $3.5 million upfront. This is the cash you get at closing. And then you could get $1.5 million, the rest of it, as an earnout. That could be paid, for example, over 3 years, and it could be tied to hitting EBITDA or profitability targets. That's $500,000 a year. Typically, EBITDA multiples in the roofing space range from 4x to 8x, but every deal is unique. The better your profitability and growth potential, the higher the multiple you can command. It's important to remember that private equity deals, they can be game changers, but there's risks that you need to watch out for. Earnout risks. Earnouts are usually linked to performance targets like EBITDA goals. But remember, private equity firms, they like to reinvest profits into growth. That could include things like expanding into new markets, upgrading technology, hiring more employees and scaling your team, and rolling out aggressive marketing campaigns. These things, while they're good for growing your business, they make it a lot harder to hit profitability targets. Retrading. This is when a buyer tries to change the deal at the last minute, usually to get you to accept less money or worse terms. Now, sometimes changes are fair, like if something unexpected came up during due diligence, but not always. Loss of control. Private equity firms will expect you to align with their goals, which may mean giving up autonomy. Make sure their vision aligns and fits with yours. Plans for your team. Some private equity firms prioritize aggressive cost cutting, which could mean layoffs, restructuring, or replacing key team members. If keeping your team intact is important to you, negotiate clear terms about roles, retention, and culture before you finalize the deal. Consult with the right advisors. Many roofing company owners turn to their existing lawyer or CPA when considering a private equity deal. While these professionals may be great at what they do, merger and acquisition deals are a completely different ballgame. The risks, negotiation tactics, and financial structure involved require specialized expertise. Work with advisors who have direct experience in mergers and acquisitions, particularly in the home services or construction industry. The right team can help you avoid costly mistakes and ensure you walk away with the best possible deal. So for decades, among other strategies, private equity firms have relied on the fractional chief marketing officer model to grow their portfolio companies. Why? Because it's a smart way to get high-level marketing leadership without the cost of a full-time executive. At TrustFactors, we're bringing this proven model to roofing companies to help them grow faster and more efficiently. Private equity is reshaping the roofing industry, creating huge opportunities for owners who are prepared. If you want to learn more about making your business more valuable, not just for private equity firms, but for your customers, check out our website at trustfactors.ai. And don't forget to subscribe to this channel for more insights just like this. Thanks for watching, and I'll see you in the next video.